Good morning, everybody. Welcome to BDO's ongoing financial reporting and accounting standards webinar series. My name is Kevin Frobus. I'm Associate Director with BDO's IFRS advisory team in Sydney. And I'll be taking you through today's webinar, which deals with IFRS 9 from a risk assessment. Our regular presenter, Aletta, is traveling, and she's handed me the reins for the full webinar. So you have me for this webinar. We're off-site today recording this webinar and presenting it. And if you do experience some technology issues, one, let us know in the questions box. But alternatively, it is being recorded, and so you will be able to access this after the webinar. So it's an hour webinar, and I'll get straight into it. The topic isn't new in this series. These are ongoing topics as part of the new accounting standards series, IFRS financial instruments. So some of this we have repeated in webinars in the past, but we're presenting it in a different format today, which is actually looking at the risk assessment side. What we mean by that is it's actually time for you to start moving beyond the theory and actually start looking at this from, well, how do you actually respond to the standard? What do you need to do? And in this webinar, we're actually looking at those areas that you need to identify that will require some effort or some type of judgment. The way I've defined that is where you need to gather information or data, and where you have to look at certain types of instrument and their features. And then also that extends to those areas where you're going to possibly have to change the way you report and how your accounting systems work, and also identifying those areas where you'll have to communicate, whether it be internally or externally to the organization. So risk assessment definition for this webinar, just in summary, those areas that you need to identify that are going to require some type of effort or judgment, some type of change to your systems, or where you might need to actually start communicating to your stakeholders internally or externally. Financial instruments in terms of IFRS 9, we've traditionally broken these into three areas: classification and measurement, impairment, and hedging. There are a couple of other topics in there, but these are the three I'll concentrate on today. So introduction-wise, I think you would have seen this transition diagram. Over the last couple of years, we've been using this one to demonstrate the mandatory effective date of IFRS 9, the financial instrument standard. And we kept moving the little red arrow, which is where we are today. And if you didn't realize it, we are well and truly into the initial application year for this standard. So the date of initial application of the standard in its entirety is 1 July 2018 if you have a 30 June financial year. So you really should have adopted the standard already in its entirety on 1 July 2018. In reality, we know that's not the case. Lots of organizations are still grappling with the revenue standard and even with the leases standard. And so financial instruments, revenue, is all happening all at the same time. And so many organizations just haven't done the risk assessment and responded to those risks in terms of getting ready for it. Very importantly, this standard is not adopted at the end of the financial year. It's adopted at the start of the financial year. So that's why this diagram is important. The date of initial application is in the past. Look behind you. And that's the day you would have needed to actually gather all this information, all this data, communicate it with your stakeholders, what's going to happen. So don't leave this till the end. If you're still in the risk assessment stage, or you're still in the up planning stage, it's better to get on this as quick as you can. And because the date of initial application is actually in the past, you can get this information, you can make these message communications to your stakeholders, you can start to change your systems now because we're already past the date of initial application. Right, in terms of our monthly financial reporting webinars, I've given you the link there to the ongoing monthly series. We've actually had a series of webinars both this year, 2018, as well as 2017. So we have actually dealt with IFRS 9 quite comprehensively. And we dealt with transition to IFRS 9 last month. That was Aletta, our National Head of IFRS Advisory, dealt with that in the June 2018 webinar. Now, the three areas I'll be dealing with today are classification, measurement, impairment, and hedging. We have dealt with these in previous webinars. So the March 2017 webinar dealt with classification and measurement. The April 2017 webinar dealt with impairment, and the December 2017 webinar dealt with hedging. I can't possibly think of anything worse than doing hedging in December, but that's what we did last year. And today I will assume you've looked at those webinars, or you've had access to those webinars. So we'll really be assuming a base knowledge in those three areas: classification and measurement, impairment and hedging. And then really talking about, well, what do you need to do from a risk assessment point of view? So where are the risks of information gathering that are going to take some time? Where are the risks of significant effort in terms of understanding your instruments, in terms of the risks of communicating to your stakeholders and the messaging you need to build in, and also the risks in terms of changes to systems and financial reporting. All right, so let's get straight into it. Classification and measurement. The message of the day with classification and measurement is that the standard setters responded to requests to simplify the standard. The problem with that is by simplifying the standard, it came with a cost, and the cost is that the accounting is perhaps a little bit more complex. What we mean by that is we don't have all these fancy classification buckets: fair value through profit and loss, loans and receivables, held to maturity financial instruments, available for sale financial instruments. They all went away, and they really came up with a very simple model. You are either at fair value through profit and loss, or you can have an amortized cost or fair value through other comprehensive income. So they really just said, well, three basic categories: fair value through profit and loss, fair value through other comprehensive income, and amortized cost. The price that came with that is that the residual changed, or the base case changed. So whereas before we used to kind of default to amortized costs first if we could, such as loans and receivables and trade receivables, we would say something along the lines of, well, we've got determinable cash flows and therefore we can account for this on an amortized cost basis. Really the default or residual value is now fair value. The standard kind of forces you into fair value as the base, and then you move to amortized cost, let's say, or fair value to other comprehensive income as an exception. That comes as a galloping shock to many people who are going through the transition, because although the categories have simplified, the accounting, you can see, immediately becomes more complex because you need to do fair value accounting for a lot more instruments than in the past. So already you can see from a risk assessment point of view that fair value and the measurement of fair value is really one of the biggest risks you're going to face. You need to understand which instruments are at fair value. How are you going to measure fair value? Do you need to involve a specialist or a valuation expert to measure the fair value? What methodology to measure fair value are you going to apply? What data inputs do you need to measure the fair value? There's a whole lot of decisions that have to go through there and system changes to work out fair value that you'll need to do, which you didn't need to do in the past when you were, let's say, using an amortized cost or cost-based model. It also means that there are more instruments that will be measured at fair value than in the past. And the best example of this is unlisted equity investments. So if you have an investment in an unlisted company, there was this default category that everybody used to use, which was measure it at cost and claim that you can't reliably measure the fair value. That category is gone under the new IFRS 9. So all your unlisted investments in equity instruments will be measured at fair value under IFRS 9. So that will transition to a fair value basis. So it will require evaluation to be performed. And already you can see from a risk assessment point of view, that's an area you would need to identify and respond to in order to transition to these standards. The classifications can be summarized very easily into this table. I actually like this table. It's quite simple and it explains how we do classification. Really, everything is fair value with a couple of exceptions, except if you can move it, let's say, into amortized cost. And amortized cost is the one that a lot of entities will currently use for their loans and receivables, their trade receivables, really anything that's got predetermined or determinable cash flows will be recognized currently on an amortized cost basis. Under the new standard IFRS 9, you can only use amortized cost if it passes two tests, the business model test and the SPPI test. So the business model test is if you hold that instrument in order to collect the cash, that's a tick, hold to collect business model. And if it is made up of cash flows that are solely payments of principal and interest, you can use amortized cost. Everything else is going to be a fair value measurement or and a classification that's either really through profit and loss or other comprehensive income. Down there with the little asterisk next to it is the one-off irrevocable election for investments in equity investments. This is really a new variant in the standard where you've got equity investments like, for example, your unlisted company shares, where you are allowed to, on an instrument by instrument basis, elect to measure it through other comprehensive income. But the trick there and the risk assessment, as far as I'm concerned, isn't where the credit's taken to. It's actually the debit has to be fair valued. And that's the big risk assessment. You're moving to a fair value model. And so many of these instruments, before you can make the election of measuring it through other comprehensive income, you need to recognize that it needs to be measured at fair value, and therefore the fair value has to be determined. And that's the bit that will take effort, data gathering, judgment calls, evaluations, and so forth. So the business model, let's run into this now. We're going to talk about the business model test. This is really how the management of the entity manages financial assets to collect the cash of that instrument or that portfolio of instruments. The business model is a matter of fact, which means it's observable. What that means is you can see relatively easily, or at least gather evidence to justify or justify why a business model is held to collect or held to sell. What it means, it's not really a judgment call, it's based on fact. So in order to make this decision in your organization, from a risk assessment point of view, you should start to put together and identify the information that supports the facts that support the business model that an instrument is managed under. What we mean by this is you actually have to look at, well, how does the entity report information on these financial assets to key management personnel? How are risks managed in the business model? So in other words, when you look at your financial instruments, and I'm going to take trade receivables as an example. If we take our trade receivables, if the entity is looking to make capital investments and buy new assets, and the only way it can do that is to cede its trade receivables to the bank or factor the receivables to the bank, that matter of fact immediately establishes a business model whereby you're actually not planning to collect the cash, you're planning to sell the cash on the trade receivable. So really gathering information about the business model level, how the financial assets are managed, how the information is reported to the key management personnel, the board, and so forth, how risks are managed in the business model, and how managers are compensated. We had one example kind of filtered to the top a couple of weeks ago, where an entity, it's obviously based on managing the share price of a listed company, and the board have taken the decision that there'll be share buybacks and a number of initiatives to try and get the share price up. In order to do that, they need cash, and what they're doing is changing the business model for the financial instruments. They are looking to change the way they manage their receivables to try and bring cash in earlier in order to then implement some of these other initiatives in order to get the share price up, which then links to their compensation schemes. So when you look at it that way, you suddenly realize that the business model for managing the financial assets can easily, very quickly take you out of a held to collect model. So a held to collect is where you plan to hold on to the instrument and collect the cash flows. A held to collect model can very quickly become a sell model when some of these factors raise their head in the way that the business model for those receivables is managed. So risk assessment is you need to start gathering information that supports your business model. It's a matter of fact and it's observable. So you need to gather those facts to justify your business model for your financial instruments. On the SPPI, this is the solely payments of principal and interest. Instruments can only be at amortized cost if the contractual cash flows are solely principal of interest related to contractual payments on specified dates. Really, if you pull this back, receivables with an interest rate on top of it are designed to compensate mostly for credit risk and time value of money. They're basic lending arrangements. Trade receivables is a good example. You give 30 days or 90 days credit to your debtors, It's a basic lending arrangement because an interest rate charged on that is ready to compensate you partly for their default or credit risk, and then time value of money, the 30 days or 90 days. The moment those instruments have a feature in it that introduce exposures of risk or volatility that are unrelated to basic lending arrangements, then you fail the SPPI test. So there are a lot of instruments at the moment that you'll have on your books that are carried at amortized cost. And one that comes to mind is a loan, let's say, with a related party, where the terms of that receivable or that loan with the related party aren't necessarily basic lending arrangements. Because they're related party, we tend to give them special terms, build in features such as prepayment options or extension options, maybe give them a below market interest rate which doesn't reset to market or doesn't actually just compensate for credit risk and time value of money. It's actually compensating for the related party transaction or the related party relationship. Those types of variabilities that are introduced or into those arrangements can mean very quickly that they fail the SPPI test. From a risk assessment point of view, you need to start to understand the features that are built into your financial assets that could potentially fail this SPPI test. Because remembering, if it fails the SPPI test, even if it's held in a business model to collect the cash flows, it will mean it will move to a fair value model, not an amortized cost model. I rambled on a little bit. I think it's time we have a poll just to see if you've been listening or if you've actually looked at our previous webinars. So I'm going to run a quick poll dealing with financial assets. And once again, I hope this works. All right. So the question is, which of these features can result in a financial asset failing the SPPI test? So we've got a loan with monthly repayments, an early settlement option. We've got an interest rate that varies with the bank rate. We've got an interest rate that resets every 6 months, a loan with an option to convert to ordinary shares, and a 15% investment in unlisted company. All right. 21% voted, so I'll leave that open. Yeah, you can choose as many options as you can, maybe all of them. Which of these these features would potentially fail the SPPI test? The vote's coming a bit slowly. We've only got 35% voted, so I'm going to assume that you're taking time to think, and that's fine. Think very carefully about it. I'm going to keep the poll open. Normally, we keep the poll open until we have about 60 or 65% of the vote, just to get a bit of feathers ruffled. So loan with a monthly repayment and an early settlement, interest rate that varies with the bank rate, interest rate that resets every 6 months, loan with option to convert to ordinary shares, 15% investment in unlisted shares. These are all pretty standard instruments. We see these regularly. A lot of them will be things like investments or loans with related parties. Remember, we're looking at the feature. So the feature in the first one, for example, is the early settlement feature. The feature in the second one is the interest rate and how it varies. And the third option. The feature in the fourth one is the conversion option to ordinary shares. And the feature in the last one is investment in unlisted company. It's actually the nature of the cash flows in that scenario, which would normally be dividends. All right. The voting seems to have tapped out, only at 53%. I'll hide my disappointment that you haven't taken an attempt, but I think we do need to move on. So I'll close the poll and share the results. All right, so 61% and 68% of you have voted in favor of the last two, which are actually the easiest one, and that's correct. Loans with a conversion option clearly have a feature that is not SPPI. The feature to convert to ordinary shares is a conversion feature that fails for solely principal and interest because there's another type of risk there, equity risk, as well as the investment in the unlisted company. There, it's not even interest really, it's dividends. So the return or the cash flow nature it makes that one fail. The other three, of course, was where we were actually trying to make this a bit more difficult. Loans with monthly repayments and early settlement options. That absolutely could be, importantly, could be a feature that results in the financial asset failing, but not always. Because if the early settlement option or prepayment option, as it's otherwise known, would still compensate the entity for solely principal and interest, well, then it could be an SPPI pass. But if the prepayment option results in volatilities and risks to the cash flows that are unrelated to credit risk and time value of money, then it could fail. So the reason why that one's in there is because the lesson is that it could fail, and that's your risk assessment. If you have loans or receivables with early settlement options, it could fail, and you need to get a handle on what the features are that come with your early settlement, and then you need to make a judgment call based on the literature and the guidance in the standard on whether it actually does fail the SPPI test. And the same with the last two, interest rates. An interest rate that varies with the bank rate. Look, there's a lot more information you probably need to make a call there, but if it's variable with the bank, provided it's still compensating for credit risk and time value of money, probably won't fail the SPPI test. The third one is actually the one that's probably more likely to fail the SPPI tests, and this is because the interest rate resets every 6 months. So that's on the assumption that if the interest rates in the market are moving, but the interest rate on the instrument only ever reset every 6 months, there's really a mismatch between when the interest rate moves on this instrument versus when the interest rate moves in the market. And that mismatch could introduce an exposure to a risk or a variability into the cash flows that's not related to a basic lending arrangement. So once again, the first three very much could be SPPI failures, and from a risk assessment point of view, you need to start understanding those features, how they change the cash flows, whether they actually are anything else other than a basic lending arrangement, which then could mean that those instruments will become fair value measurement instruments. All right, I have to figure out the IT and move on to the next one. So there are the 4 points I've just mentioned. Features that introduce risk and volatility, probably need to identify that. You need to take a step back and understand the model that governs your management of cash flows. This is the business model test. Even if it passes the SPPI test and you are carrying those instruments to collect or to be compensated for principal and interest, it's very possible that if you are managing the portfolio of instruments to sell the instruments, it's going to be a fair value instrument anyhow. Like I said, best example there is actually factored receivables factored to the bank. If you regularly factor your receivables to the bank, you're managing them with a business model that's other than collection. Therefore, it's selling. It's probably at fair value. And then you can obviously see that if you are going to end up under fair value, you need to figure out a way you're going to measure the fair value. And this would be measuring the fair value at each reporting date. So you'll need to develop an approach that calculates your fair value on those instruments and the inputs necessary. I just put communication on here because we started to run into this issue that those instruments that are becoming fair value instruments will start to reintroduce into your financials a volatility into profit and loss, because if they're unhedged measures of fair value and they're fair value through profit and loss instruments, you're going to start getting fair value movements each reporting period back into P&L, which you wouldn't have had under the, let's say, amortized cost model. That is something you might want to message to your investors and even to your internal management team or to your board, to let them know that those instruments that are fair value through profit and loss will introduce this ongoing volatility adjustment into P&L, which maybe wasn't there in the past. So that's something you might want to get a handle on relatively quickly. All right, let's move into impairment. Impairment right now is the fund standard. The fund standard, because it introduces the so-called expected credit loss model into our financial assets, or some of our financial assets. Very, very definitely the amortized cost instruments will have impairment under IFRS 9 under the expected credit loss model, and then obviously some of the fair value through other comprehensive income instruments. The debt instruments that fall into the fair value through other comprehensive income category will also have impairment issues which have to be considered. So it's really just restricted to those two main categories, amortized cost and fair value through other comprehensive income debt instruments. They will have impairment issues. The expected credit loss model looks something like this, which is quite confronting when you see it summarized this way. There's lots going on the slide. It breaks your impairment assessment down into 3 stages, stage 1, 2, and 3. Stage 1 is where you have performing instruments. And let's say it's an amortized cost performing instrument. I'm going to assume a trade receivable for this example. Got a trade receivable, so your normal debtors, they're performing. What that means is your debtors have a strong capacity to meet repayment. So the credit risk in that scenario is in stage 1 or the lowest of the stages. But that doesn't mean there's no allowance recorded against it. The new impairment model requires you to recognize, in that case, 12-month expected credit losses against those receivable. And this is because of the understanding that the risk of default or the credit risk in every instrument, including those that are performing, is implicitly there. There is a credit risk in everything. Everything has a credit risk in it. This model tends to bring some of those credit risk allowances forward. So you recognize an allowance against your receivables, even those in stage 1, even if it's a small balance. And the small balances that is recognized in stage 1 are what we call the 12-month expected credit losses. Those are recognized against stage 1. When the credit risk or the risk of default of the instrument starts to change, it moves to stage 2 or even stage 3. What that means is the instruments become underperforming or non-performing. And then you start to recognize more of these credit allowances. Now, I'm not going to deal too much with this because, as I said, we have a webinar that deals with this quite comprehensively. This webinar is more about risk assessment. So how do you start to identify issues that you need to respond to? And I think the message is already clear. If you have an amortized cost instrument or a debt instrument that's fair value through other comprehensive income, they must have this impairment model applied to them, which means you're going to have at least 12-month expected credit losses recognized against them, which means you need to start responding to the information that needs to be gathered and the judgments that need to be made in order to work that number out. And remember, our date of initial application is behind us. It's 1 July 2018. So you really need to start having this built into your accounting systems now already. Just for fun, we'll have another poll just to test whether you've been listening. Which of these assets will have the IFRS 9 expected credit loss applied against them? So we've got a contract asset, lease receivables to be factored with the bank, trade receivables, and loans with related parties. It seems from the voting that you're a lot more certain on this one. The numbers are popping up quite quickly. Contract assets, lease receivables to be factored with the bank, trade receivables, and loans with related party. All right. So I'll close the poll there. We can have a look at the results. Just check that they're showing up. All right, so seems to be most people got that right. I mean, contract assets, I put in there just to throw the conversation a little bit. Contract assets arise from the revenue standard, but they do or are subject to the IFRS 9 impairment assessment. So yes, absolutely, contract assets should be assessed under IFRS 9 impairment. Lease receivables, Absolutely, lease receivables fall under a different standard. They come from the leases standard, but their impairment also falls under IFRS 9 because they are financial receivables after all. And likewise, lease receivables that are going to be factored with the bank, they absolutely also are subject to impairment. Lease receivables to be factored with the bank is a good example of an instrument that probably is SPPI. It passes the SPPI test, but it fails the business model test because the business model is to sell those instruments to the bank. So those will be at fair value through other comprehensive income. But fair value through other comprehensive income actually has two components to it, the fair value adjustment and the amortized cost adjustment. So yes, the impairment session absolutely applies. Trade receivables is an easy one. That will be at amortized cost normally, and so it absolutely is subject to the impairment model. And loans with related party absolutely as well will be subject to the impairment model, provided it's recorded at amortized cost or fair value through other comprehensive income. Okay. Just once again trying to figure out the technology. And I think we're back on track. Right. I did decide that I'd do a very, very quick example on this impairment, just to show you the type of thinking that goes with it. And therefore, you, from a risk assessment point of view, you can start to think about, well, how am I going to actually address this? What information do I need to gather? Where am I going to get it? What judgments do I need to make? What will my accounting system changes look like? Now, because it's a 1 hour session, I'm not going to spend time working through every number, so it'll be very quick. And I recommend that you come back to this webinar and go through each of these slides on your own. You do have the handout, so you have this in front of you, and you can work out the numbers yourself. But I will actually, at least at a high level, show you what they're trying to achieve. So here we have a loan of $1 million, which bears a 5% interest rate, repayable in 2 years' time. Now that will pass the SPPI test because there you have a principal and you have an interest that's compensating you for credit risk and time value of money. Assuming it passes the hold to collect model, it'll be measured at amortized cost. And so now we must subject it to impairment under IFRS 9. At the end of year 1, the borrower has indicated it will only repay at the end of year 3. In other words, another year will be granted in terms of repayment, and no interest will be paid for year 3. So it's probably a related party loan because there's some weird terms going on here. I'm going to assume for this example that it continues to be an amortized cost instrument, or is an amortized cost instrument, and I'm also going to assume there's no change in credit risk. What I mean by that, there is obviously credit loss, and this is really important. Because we've got an extra year that we're giving the borrower and we're not going to earn interest in year 3, we are clearly incurring a credit loss purely just based on the fact that another year of credit has been granted. We're bearing the credit loss because of time value of money. There will be some questions here about whether this passes the amortized cost SPPI test, but for purposes of this example, I'm going to assume that it still does. So we have an amortized cost loan where we've had a credit loss incurred because the terms have extended the credit to the borrower for a little bit. And I'm also assuming no change in the credit risk. So I'm still assuming a stage 1 impairment loss or impairment assessment. So this is what the entity would be expected to do. One is you first have to work out what the present value of the loan is if paid on time. In other words, this is the amortized cost if nothing changed. They would receive interest in the first year, 5%, and then in year 2, there would have been interest in the second year, plus the repayment of the capital. That would have given you a present value or an amortized cost of $1 million at the start, which is obviously what we started the loan with. The loan would then build up at a 5% interest rate with repayments. The SPPI test would unwind the present value over the 2 years. So this is SPPI or amortized cost at its most basic. Now what has to happen is the entity must work out the credit loss with the repayment changes. So the repayment changes were that they would pay the capital back in year 3, and there wouldn't be interest in year 3. So a little bit weird, but this is to demonstrate to you what's expected for you if you're running an impairment expected credit loss model under IFRS 9. Using the same discount rate of 5%, a credit loss has been incurred of 43,192. So $43,192. How did we get that? Well, we're really just using the original discount rate of 5%. The cash flows have now changed. Years 1, 2, and 3 have different cash flows. And when we discount that back and compare that to the 1 million present value in the previous slide, the credit loss that we have incurred or that can be incurred here is 43,192. Now it gets fun because that's not the credit loss you recognize. Because I said to you, we're still in stage 1. We have not had a change in credit risk. Even though we have a credit loss, the credit risk, in other words, the risk of default, hasn't changed. So the entity assumes that this particular scenario, the one that the borrowers promised, it has a 30% chance of occurring. The entity actually thinks that what's going to happen really, in other words, with a 70% chance, is that really another year is going to be granted. This is just going to go on a little bit. Probably these types of scenarios arise in related party arrangements where the entity will say, no, look, we know what's going to happen here. What's really going to happen is there's going to be a 4th year. The 4th year won't have interest, and that's when we'll get our $1 million back. So you can see that the more likely outcome is that there'll actually be a bigger credit loss incurred by the entity. 915,673 is what's going to happen. So the entity does this. It takes the 2 scenarios. It says, look, we know there's a 30% chance of the first scenario, which is where they repay after 3 years. But really, the scenario that we're going to give a bigger weighting to, the 70% chance, is the scenario where they pay after year 4. So the weighted credit loss, average credit loss in that scenario, is the weighting of the credit loss between the 2. It's the $1 million under the original terms minus the present values under the 2 scenario give you the credit loss, which is then weighted to create a weighted average expected credit loss. If at this point you have no idea what I'm talking about, then you have a risk assessment issue. You need to get on top of this because this is what's going to happen for all your instruments at amortized cost or that fall into the debt instruments through other comprehensive income. Carrying on, the entity then has to estimate a probability of default over the life. So we were just working out the expected credit loss before. Now we actually have to work out the probability of default. And we've got 2 best case scenarios. The 2 best case scenarios in this example are the base case where they pay after 3 years and the base case where they pay after 4 years, where we have assumed no default. In other words, although we're incurring a credit loss, we don't expect default. And then there's always a worst case scenario, at least a minimum worst case scenario. What if they do default? And we stick a probability of default of 26% onto that. That 26% then is our probability of default over the lifetime of the instrument. Because we're still in stage 1, we're actually working towards 12 months expected credit losses. So now we estimate what's the probability of that happening in the next 12 months. Now, I've gone with a 4% here. So the worst case scenario, the default scenario in the next 12 months is 4%. So lifetime expected credit losses in this case are the weighted average expected credit losses that I've incurred are 71,986 times the default rate of 26% in those scenarios. And the 12-month expected credit loss, if I'm still in stage 1 of the impairment model, is really just the same number at 4%. All right. Why did I put the slide, that example on? I did put the slide on to maybe just overcomplicate the scenario, but it's not really a very complicated scenario. It's a pretty relevant example. A lot of entities will have these. You'll have a loan with a related party with a 2 or 3 year repayment period where the terms change in some way, where losses are incurred because of time value of money. And now the entity has to start to actually estimate its weighted average expected credit loss, work out a probability default rate based on historical evidence, but also based on what they think is going to happen in the future, and factor in the time value of money. The models are not easy. They're probably a lot more complicated for financial institutions and banks, but every entity that has an amortized cost instrument or a debt instrument that's measured through OCI will have this type of thinking applied to it under the new standard. So from a risk assessment point of view for impairment, what information are you going to have to gather? The information you're going to have to gather are reasonable and supportable information, such as previous default rates, as well as then adjusting those default rates for what you think is going to happen in the future, so forward-looking. You're going to have to start getting calculations prepared for the appropriate level of credit risk. So stage 1 is 12-month lifetime expected credit losses. Stage 2 and 3 are full-time expected credit losses. You're going to need to incorporate unbiased probability weighted default considerations. In my previous example, that's where I was saying 30%, 70%, those types of probability weights were factored in because you're scenario building what's going to happen and probability weighting those scenarios. And then, of course, you need to consider the impact on the financial reporting and accounting systems. Just going back to the answers in the previous example, just want you to realize the quantum here. We were working with a $1 million loan, and the 12-month expected credit loss was only $2,879. So that is probably immaterial. But we need to know how to get to that conclusion that it's immaterial. And you can see with the lifetime expected credit losses, it's only 18,716, which might also be immaterial to an entity. But we needed to know the data, and we needed to make the judgment calls in order to arrive at that number to make the conclusion that it's immaterial. So those will all have to come into your assessments. The numbers, they might be quite small, and maybe from a materiality, this might not even get recognized. But you need to know why you get to that number and why it's immaterial. All right, so I'll move on. I've got about 15 minutes to go. I was dealing with the general approach to impairment under IFRS 9. There is a simplified approach, which trade receivables and lease receivables and contract assets can, under certain scenarios, comply with. The simplified approach at a very high level just leaves out the time value of money component, but it still requires you to come up with an expected default rate, or a default rate that is based on reasonable and supportable inputs, based on historical and forward-looking information, and considers the various alternatives. So it's simplified mostly in the time value of money aspect, but it still requires you to recognize some type of expected credit loss against it. And in this scenario, very basic scenario, the simplified approach that the accounting standard deals with tends to deal with it based in the bands that go with trade receivables. So normally this is a good example of how trade receivables are normally categorized: current, 30 days past due, and so forth. But the trick here is to recognize that even those instruments that are in current have a very small, but they do have an expected default rate of 0.5%, which leads to a credit loss allowance being recorded against that in the financial statement. So that's the important bit. Current receivables in this scenario are clearly in stage 1, and they do have some type of adjustment against them. There are a couple of questions coming through. I'll address those at the end. So I'll just finish off with the hedging session. In actual fact, with the hedging, I have not done much in terms of bringing lots of slides through because it's quite a specialized topic. But I did decide to throw a third poll in here just to see if any of you are game to try and make take a punt at some of the questions that I put in front of you. So I'll open the poll. And give you a bit of a go on that one. The poll, I can't see the question myself now, but it's something along the lines of which of these characteristics of hedge accounting are applicable under IFRS 9. Please don't worry if this is not your area. Not every entity applies hedging and needs to apply hedging. So like I said, this is a specialist scenario. See what you can come up with. Which of these are characteristics of hedge accounting under IFRS 9? Having said that, everybody seems to be having a go at it, so I'm glad that you're all on top of it. So first option is hedge offset must be within the 80 to 120% range. Entities are allowed to hedge non-financial asset components. There is no need to document hedge strategy, only the hedge relationship. Sorry, I just need to point out that the word cut off on the third option. That should read no need for documented hedge strategy, only the hedge relationship needs to be documented. That's number 3. and retrospective and prospective hedge effective testing is required under IFRS 9. All right. The voting is going off, so I'm glad that's happening. I'll leave that open for a while. Just summarizing again, which of these characteristics of hedge accounting apply under IFRS 9? Hedge effectiveness, hedge offset must be within 80 and 120%. Entities are allowed to hedge non-financial asset components. There's no need for documented hedge strategy, only hedge relationships need to be documented. And retrospective and prospective hedge effective testing is what's required. Okay. I'm going to close the poll. It has started to stagnate, and we can have a look at the results. Interestingly, yeah, I've once again tricked you all. The only one of those requirements that's actually relevant under IFRS 9 is the second one. Entities are allowed to hedge non-financial asset components. Under IFRS 9, the hedge offset is not dictated by the 80-120% rule. That 80-120% rule has actually under IAS 39, the old hedging standard, it has not been taken forward into the new standard. In terms of hedge strategy documentation, most of you got that right, obviously. It is vitally important that the hedge strategy and hedge relationships are documented. The hedging documentation requirements have not been simplified, or they aren't less stringent under the new standard. You still need to have your documented hedge strategy and hedging relationship documentation. And then in terms of retrospective and prospective hedge effectiveness, it's more of prospective hedge effective testing under the new standard with ratio rebalancing. So the retrospective has been relaxed. So it really was just the second one that was the characteristic under 9. But that's okay. Hedging, there it is. I'm just going to summarize this in a slide for you. Did I share those results? All right. I am having a bit of a technology issue, so I can't always see what you are seeing, but I think you can see now the slides. This is just a very high level of the changes from the current accounting standard, IAS 39, to IFRS 9. The arbitrary rules are replaced with principle-based requirements. So one of those is the 80-125 effectiveness test has been removed. That's no longer there under IFRS 9, but it has been replaced with a risk management objective or line to risk management objective with a prospective effectiveness test with ratio rebalancing. That should say ratio rebalancing, sorry, not ration rebalancing. Just an error I suddenly spotted on the slide. And the hedge effectiveness must be linked to documented risk management strategy and objectives. It must still document these relationships and have them in place. From a risk assessment point of view, if you want to apply hedging going forward, my best advice is to make sure your documented risk management strategy and objectives are in place. That's the first question you're going to get from any auditor or anybody who's going to say to you, are you complying with it? Once again, the new standard does allow more ratios, more relationships to be hedged. So it's a lot more flexible in linking to an entity's strategies and objectives. It's a lot more business orientated. It's not so restrictive. But in order to achieve it, you still need to actually make sure you are documenting what you're trying to achieve. In other words, you need to formalize your treasury function in this regard to achieve hedging under IFRS 9. That is still required. Okay. The one thing on a risk assessment is also just to make sure if you need to involve a specialist, you do. It has become a very specialist topic, this, depending on your type of business and the types of hedging you've got. There are still certain types of instruments like interest rate swaps and forward exchange contracts where you don't need to involve a specialist. But when you start to get to a little bit more complicated issues, you might want to bring somebody in who can help you with that. And it may not be a bad idea to get your treasury function and your strategy and objectives documented with some outside help. Okay, before I get to all the questions, I will just quickly follow. Well, let's actually get to those now. There are 3 or 4 questions lurking. First question asks for us for the valuations of unlisted companies. So we're going back now to financial assets or investments in unlisted entities, which are valued now at fair value. Does this apply to fully owned subsidiaries, or can they still be valued at only the cost of the shares? Very, very good question. It's a complicated one. At the consolidated level, I'd imagine that investment would be consolidated out. So this is really at the separate financial statement level. What you're really asking is in the separate financials at the holding company level, do those investments in subsidiary, are they required to be fair valued, or can they still be valued at the cost of the shares? The answer is that they're actually outside of IFRS 9. They are under a separate standard that deal with investments in subsidiaries. And you're absolutely right. There are options there to value it either at cost or at fair value. So that allowance for those types of instruments still does apply. Because they're actually outside of the consolidated set, they're at the separate financial statement level. So yes, those allowances for investments in subsidiary are absolutely dealt with and can still be valued at a cost or fair value basis. The same answer for investments in subsidiary in associates and joint arrangements. The investments in those instruments are outside of IFRS 9. They are dealt with by the relevant standards on associates, subsidiaries, and joint ventures. Next one are the loans, including related party loans for unlisted companies, to be assessed for impairment under the simplified approach. In order to be measured at the simplified approach, it's really a factor of time value of money, whether they're recovered within 12 months or less. My gut answer is to say, in the general rule, no, I wouldn't expect a simplified method to be used for loans in related party. I would expect you to see a general approach applied there. A question then also came on how to get the default rate in the slide. That's the point. That's one of the points I was making in terms of risk assessment. Getting the default rate is actually some of the hard work. You actually need to look back in the past in terms of establishing what your past default rate was for those types of instruments or that portfolio. And then you have to base it on future or forward-looking estimates, which hopefully would be market-related. Macroeconomic type data would then influence you to change your historical rate to try and reflect what you think is going to happen in the future. So how do you get your default rate? That is the million-dollar question. That's part of what we were trying to say to you today. The default rate is one of the big judgment calls under the new standard, but it must be based on reasonable and supportable data and information, whether that be historical as well as adjusted for future-looking macroeconomic type information. And you need to come up with a methodology which is applied consistently to actually arrive at that rate. So that actually is a very good question. How do you get your default rate? With a lot of effort and thinking. Are there impairment testing templates available for the new accounting standard? I'm sure there are. We do have some floating around. You just need to talk to your advisor on those. And a last question is, how would we classify convertible preference shares and bonds with floating rate of interest under new AASB 9? I'm not sure if you're asking that question from the liability side or the asset side. If you're asking the question, how would we classify convertible preference shares and bonds with floating rates of interest under AASB 9 from the financial asset side, it just sounds like a fair value instrument. Lots of features going on there which probably fail the SPPI test. From the liability side, you still need to look at whether it's a liability or equity or compound type instrument. Those rules haven't really changed on the liability side. I think I've got all the questions. They're popping up in a big model, and the screen I'm working off is a little bit small, but I think I've covered them all. There's a couple of comments which I think were actually answers to my questions. So they're not more questions, they're actually just ongoing questions. I think if you need assistance, I'll put this on the board. One is we've already had our financial reporting webinar series ongoing basis. And next month we'll look at IFRS 9 problem areas. I can almost guarantee that the problem areas for next month's webinar will kind of be the same as this month. They are all problem areas. So in many ways, next month's webinar is probably a continuation of this month's webinar. For those of you who had questions, if you want to give me a ring, I'm more than happy to have a conversation with you. You can find my details on our website. But from a technical advice point of view, I'm based in Sydney, so the relevant person to contact is probably the person in your region. Aletta Boshoff in Melbourne, Wayne Basford in Perth, and Clark Gerald in Brisbane. But like I said, give any of us a call or myself a call or send me an email. Our contact details are on our web. More than happy to engage with you on some of these issues. The 4 people on the board form part of our broader IFRS advisory team, which are based throughout Australia and New Zealand. And I should probably put a disclaimer on here just to make sure you understand that this is general advice, and obviously your specific scenarios, especially where it comes to judgments around features within instruments and how that affects classifications, those can turn on a dime. So please make sure you seek relevant, specific, tailored advice, and take this webinar as a general education. It's intended to help you with identifying your risks that you need to respond to. We have 4 minutes to go. I'm going to close off the webinar and say that I've never finished a webinar early. But hopefully you've enjoyed that and taken something out of it, and we'll see you next time. Thank you very much and goodbye.